Welcome to another journey into the fascinating world of finance. But first, remember, we are not financial advisors and you should do your own research. Now let's dive in. Finance, it's the lifeblood of our economies, the engine that drives growth and prosperity. It encompasses everything from your daily cup of coffee purchase to billion-dollar mergers and acquisitions. Today, we're focusing on two particularly intriguing aspects of finance: stocks and cryptocurrencies. Stocks, the classic investment vehicle allowing you to own a slice of a company, and cryptocurrencies, the new kids on the block, shaking up the financial world with their decentralized, digital nature. Each of these financial instruments offers unique opportunities and challenges, and they're both instrumental in shaping the future of finance. As we delve into these two financial instruments, keep in mind that both come with their own sets of risks and rewards. Stocks, a term you've probably heard 1,000 times, but what exactly are they? Let's dive in. Imagine owning a piece of your favorite company, say a tech giant or a fast food chain. That's what buying a stock means. You're purchasing a tiny slice of that company, becoming a shareholder. If the company does well, so does your investment. If it stumbles, your investment might falter too. But how do you buy a stock? It's quite simple. They're usually purchased through exchanges, platforms where buyers and sellers meet. The most well-known exchanges are perhaps the New York Stock Exchange and the NASDAQ. Now you might wonder, who's in charge of all this? Who ensures fairness? That's where regulatory bodies come in, the most notable being the Securities and Exchange Commission, or the SEC. The SEC's job is to protect investors, maintain fair markets, and facilitate capital formation. They do this by enforcing laws that promote transparency and honesty in the market. The SEC requires companies to disclose meaningful financial information publicly. This provides a common pool of knowledge for all investors to use to judge for themselves whether to buy, sell, or hold a particular security. In short, it levels the playing field for all investors. But the SEC doesn't stop there. They also oversee key participants in the securities world, including stock exchanges, broker-dealers, investment advisors, and mutual funds. The SEC is concerned primarily with promoting the disclosure of important market-related information, maintaining fair dealing, and protecting against fraud. To sum up, stocks are pieces of ownership in a company. They are traded on exchanges and are overseen by regulatory bodies like the SEC, which ensure transparency, fairness, and protection against fraud. So, that's a brief look into the regulated world of stocks. Now let's shift gears and talk about a different beast altogether: cryptocurrencies. Cryptocurrencies, the new kid on the block, have been making waves. But what are they really? In essence, cryptocurrencies are currencies that use cryptography for security. Primarily built on a technology called blockchain, a distributed ledger enforced by a network of computers or nodes, each holding a copy of the entire ledger. This decentralization is what makes them fundamentally different from traditional finance systems, which rely on central banks or authorities. Now, what's the purpose of cryptocurrencies? Initially, they were developed as a form of digital cash, a way to exchange value over the internet without the need for a middleman like a bank or a financial institution. Bitcoin, the first and most well-known cryptocurrency, was created in 2009 by an anonymous person or group known as Satoshi Nakamoto, with this exact purpose in mind. But as the technology matured, the potential use cases of cryptocurrencies expanded. Today they are used for a wide range of applications, from smart contracts that automatically execute when certain conditions are met, to decentralized finance, or DeFi, which aims to recreate traditional financial systems in a decentralized way. However, this brave new world of finance is not without its risks. Cryptocurrencies are largely unregulated, and while this can lead to opportunities for high returns, it also exposes investors to high risk. The value of cryptocurrencies can be extremely volatile, with prices that can skyrocket or plummet in a matter of hours. Moreover, the lack of regulation can also make the crypto market a breeding ground for scams and fraudulent activities. Cryptocurrencies, therefore, represent a double-edged sword. On one hand, they offer a new way to transfer value, create decentralized applications, and potentially earn high returns. On the other hand, they carry significant risks due to their volatility and lack of regulation. Cryptocurrencies, a whole new world with its own set of rules. Or perhaps, a lack thereof. Now that we've gotten a basic understanding of both stocks and cryptocurrencies, it's time to see them side by side. Diving right in, stocks are heavily regulated by governmental bodies such as the Securities and Exchange Commission in the United States. This regulation provides a level of protection for investors, as companies must adhere to strict reporting standards and transparency requirements. However, this also means that the stock market can be influenced by political and economic events, such as changes in government or fluctuations in the economy. On the other hand, cryptocurrencies exist in a largely unregulated environment. They operate on decentralized networks and are not controlled by any single entity. This lack of regulation can be seen as a pro or a con, depending on your perspective. On the plus side, cryptocurrencies can offer a level of freedom and privacy that traditional stocks cannot. They are not subject to the same governmental controls, which means they can be less susceptible to political and economic turbulence. However, this lack of regulation also brings certain risks. Cryptocurrencies can be highly volatile, with values that can skyrocket or plummet in a matter of hours. The anonymity of transactions can also make them a target for illegal activities, such as money laundering or fraud. And without a central authority to oversee transactions, disputes can be harder to resolve. So how does this affect you as an investor? Well, if you're looking for a stable and regulated investment, stocks might be the way to go. You'll have the reassurance of knowing that companies are held to stringent standards of transparency and accountability. But if you're willing to take on more risk for the potential of high returns, cryptocurrencies could be worth considering. Just remember, the world of cryptocurrency is like the Wild West of investing. Thrilling, but potentially hazardous. It's essential to do your homework and understand the risks before diving in. As you can see, the level of regulation in stocks and cryptocurrencies can significantly affect your investment strategy. So, there you have it, stocks and cryptocurrencies, two distinctly different financial instruments with their own unique regulatory environments. We've delved into the world of finance, untangling the concepts of stocks and cryptocurrencies, and explored their regulatory landscapes. Stocks, time-tested and regulated, offer stability and dividends. Cryptocurrencies, on the other hand, are the new kids on the block, teeming with potential yet volatile and existing in a less regulated space. It's crucial to remember that this video isn't financial advice. It's a stepping stone, an introduction to help you understand these two fascinating worlds. Always do your own research before making any investment decisions. Be patient, be diligent, and most importantly, be informed. Thanks for joining us on this financial journey. Remember to like, comment, and subscribe, and don't forget to hit the bell notification so you'll get updates anytime we upload a new video. Until next time, stay financially savvy.